We're going to talk about the impact of taxation. We're also going to talk about the Secure Act and the CARES Act and their potential impact for you as an individual. We're also going to talk about some strategies. We're going to talk about our first strategy is loading up on those retirement plans. We're going to talk about Roth conversions. We're going to talk about tax bracket management. We're also going to, last but certainly not least, is focus a little bit on tax loss harvesting. That's an important part of the year-end tax strategy as well. But taxes, as I said earlier, is just not a very fun subject to talk about. But unfortunately, there's a lot of narrative in what we do for our clients, and our clients see a lot and hear a lot of narrative. And we at our firm at Pineswell strictly like to stick to the facts. And that's what we're going to do is throughout this webinar, we're going to just strictly look at the facts. I'm not interested in the politics or the narrative. I want to stick to exactly what's important and why you need to be aware of what's happening. So let's talk about Uncle Sam for a minute. And here you see the iconic picture of Uncle Sam, right? I know whenever someone mentions Uncle Sam to me, I always think of this picture, and I always think of that poster that we've all seen so many times hanging on the wall and says, Uncle Sam wants you for U.S. Army. Well, for purposes of this presentation, Uncle Sam, he doesn't want you. Uncle Sam wants and he wants your money. That's exactly right. Because the only way that the federal government can raise revenue is through taxation. They don't make anything. They don't produce anything. So the only revenue that they can bring in is by your tax dollars. And the biggest misconception, in fact, I was meeting with the client a couple of weeks ago, and we got talking about mortgage rates and how low they are and how favorable. And he was talking about upgrading his house. And it was a big financial commitment for him because and he made the comment to me that it was the biggest financial commitment of his life. And so we got a little bit farther in the conversation. I said, it's not the biggest financial commitment that you'll make in your life. It's not your house. That's a big misconception. The biggest financial commitment that you'll ever make in your life is the amount of taxes that you pay. In fact, there was a study done recently by moneyrates.com that said the average worker throughout their entire life will pay over $700,000 in taxes. That's for the average worker. $700,000. There's no way you're going to pay $700,000 to your mortgage company, to your bank for that mortgage. So that is going to be your largest financial commitment is taxes. That's the reason why it's so important. And how it's set up today is that we have 7 tax brackets from our lowest bracket is 10%, our top bracket is 37%. And the other important part that I want you to know is that our system is a graduated tax system. It's not a flat tax system. And what I mean by a graduated tax system is that for the first $19,750 that you earn, you'll pay 10% of the federal income tax on that first $19,000. And then the next $60,499, you'll pay 12%, and so on and so forth. So let's take an example that if you're in the 37% tax bracket, you don't pay a flat 37% on all of your income. Your federal tax will be graduated to where you'll pay a little bit in the 10, a little bit in the 12, and so on and so forth. So keep that in mind that it's not a flat tax system. So when you talk about that, you talk about federal income tax, but that's not all. You have to worry about Social Security tax. That's on your pay stub. Whenever you get paid from your employer, that Social Security tax is there, and that rate is 6.2%. You also have to worry about Medicare. You pay for that on your paycheck. That's 7.65%. And then if you're lucky enough to die with a considerable estate, you are subject potentially to estate taxes. So not only do you have taxes upon your income while you're working, but you also have potential estate taxes upon wealth transfer. And by the way, the Biden administration is talking about reducing the estate tax exemption from its current amount of $11.5 million back down to $5 million. And I obviously with the election just yesterday evening, we don't have a declared winner yet. So I don't know who's going to win. And my point being is that we need to be aware if there is going to be a change at the top, what potential tax changes that new administration is going to be talking about and going to be implementing. And estate taxes is one of them. So not only do we have federal income tax, we've got Social Security tax, Medicare tax, and potentially estate tax, which after paying all that, it leaves you, it doesn't leave you much. Okay, there's not much in the pockets after all that tax. But if you do have some left in the pocket, guess who else wants a piece? Not only does Big Brother want a piece, but Little Brother wants his cut. And what do I mean when I say Little Brother? Well, you got property taxes. If you're fortunate enough to own a home, you know exactly what I'm talking about. Depending upon where you live, you'll have to pay property taxes. Another little brother is your state that you live in. They are going to require state income taxes. And we have clients all over the United States. We have clients in Florida, California, Texas, Iowa, Ohio, Nebraska, New Jersey, and their state income tax rates are at different rates, obviously, and you have to plan for that. But little brother wants to get paid. State income taxes are due as well. Not only that, but you have to pay a sales tax. So whenever you go to Walmart, whenever you go to Best Buy or wherever retail wise, you have to pay a sales tax. And last but certainly not least is excise tax. So whenever excise tax refers to those specific products, example would be like tobacco, gas, alcohol. Those are excise taxes. Which once again, so if you consider your federal income tax, Medicare, Social Security, state taxes, property taxes, excise taxes, sales taxes, that leaves you, once again, not much. So that's why it's very important part of your financial plan. Taxes should be. And nobody wants to talk about taxes because it's such a huge hassle. It's a pain point, right? I'm sure taxes is a pain point for you. Be surprised if it isn't. But it is important that you incorporate tax planning into your financial plan. And not a lot of financial planning firms do that. And that's a mistake because it can mean a huge difference in your outcome. And let's look at that really quickly. So again, my goal is not to have you become a tax expert by the end of this webinar. I don't want you to have a comprehensive understanding of the tax code. That's what your accountant is for. But understanding the impact of taxation and how it could potentially mean the difference between a successful retirement and an unsuccessful retirement, well, it can make a big difference. So here you're looking at a 92-year period from 1926 through 2017. I don't have 2018, 2019 numbers yet, but after I get those, I'll certainly update this slide. But here you can see on the left-hand side, you can see the rate of return after taxes. So if you pay taxes along the way, for those of you that are our clients, you will commonly, or we refer to this type of investment where you pay taxes along the way as your midterm bucket in your bucket system that we've set up for you. But if we do not pay taxes along the way, in other words, we defer them as long as possible till we absolutely have to, your rate of return can be as much as a 20% difference, 10.2 for the investment where you don't pay taxes and 8.2% rate of return for an investment to where you do pay taxes. So that 20% could be the difference between you being able to achieve your goals and falling short of your goals. So it matters that much. And if you think the future of tax rates, well, I've got some bad news and I've got some worse news. Bad news is the future of tax rates, they aren't going down. That's the bad news. The worst news is because the Tax Cut and Jobs Act of 2017, which lowered our tax rates to the rates that we have today, that expires in 2025 automatically. Now, you throw in a pandemic and you throw in record amounts of federal spending, guess what you're going to get? That is not a recipe for future tax reduction. That's a recipe for future tax increases. So the tax brackets, the tax rates that you're seeing right now, you're likely not going to see those again probably for a long time, especially if we have a change in administration. And even if we don't have a change in administration, in 2025, the Tax Cut and Job Act is going to end. And so tax rates will probably more than likely go up. So that's what makes this discussion even more important. So let's go on to a couple of things that's happened over the last 12 months that have made an impact for individual investors. Let's talk about the Secure Act. And as Congress is wanting to do, they always like to, anytime there's a major legislation that comes down the pike, they always attach an acronym to it. And the Secure Act, the acronym is, or the meaning of the Secure Act is, Secure stands for setting every community up for Retirement Enhancement Act of 2019. So setting every community up for retirement enhancement is the acronym for the Secure Act. And it made a couple of significant changes for individuals. First of all, it changed IRA required minimum distributions. It changed them from 70 and a half to age 72. So you were no longer forced to take money out until age 72. So on the left hand, what the government is doing is they're saying, you know what? Hey, Mr. and Mrs. Investor, we're going to give you another year and a half of tax deferral. Here's our gift to you, another year and a half of tax deferral. That's what they give you on the left hand. But what they don't tell you, and what the IRS is considering, is on the right hand, they're also considering a revision to the required minimum distribution tables. They're telling us that in late 2021, they're going to come out with a new required minimum distribution table, which I suspect that which they give you on the left, they will take away with the right. In that, when you do start taking out your required minimum distributions at age 72, guess what? Yep, you're going to have to start taking out more. So yeah, they're trying to pat themselves on the back by telling you, hey, we're going to give you another year and a half of tax deferral, yippee for us. But on the other hand, I suspect they're going to raise those required minimum distribution amounts that you're going to have to take when you do start taking them at age 72. So just be aware of that. The other change is that you can contribute to traditional IRAs past age 70 and a half if you have earned income. So keep that in mind. Whereas before the Secure Act, once you reach 70 and a half, you could no longer contribute to IRAs, but you can contribute to IRAs past 70 and a half. The only exception here, or not the only exception, but the caveat here is that if you do contribute to your IRA, let's say you're age 85, you're still working, you're still healthy, you're still doing well, you're still earning income, you will have to take that RMD. Now, you can make a contribution to your IRA, but on the other hand, you've got to take your RMD. So it may be a tax neutral type of situation for you. But let's take a look at some other changes. They made a change to the stretch IRA. And notice how I incorporated the yoga class here. They're all stretching out. I incorporated that picture with the stretch IRA. Get that. Anyway, so the stretch IRA has changed dramatically for non-spousal beneficiaries of IRAs. And now your non-spousal beneficiary of your IRA has to take the money out within 10 years. They can no longer stretch it over their lifetime. Now, the beneficiary can take it out whatever percentage they want per year, but it all has to be out of there by the 10th year. So there's no annual requirements for withdrawals, unlike the stretch IRA that requires you to take out a little bit per year. So you could continue to defer those taxes as a non-spousal beneficiary on that inherited IRA. But the problem is that you could potentially compound your tax problem because it stays in there for 10 years. And as it gets closer to that 10-year deadline, yeah, you got to take out more, which could alter your tax brackets. And as we just talked about, guess what? Tax rates are going up, not down. So now all of a sudden you're paying a lot more on those taxes, you're paying a lot more on those withdrawals because you've delayed them. That's after 10 years. Now there is exceptions to this 10-year rule. And the IRS and Congress always makes exceptions to rules, right? And the exceptions is that spouses, you are not subject to that 10-year distribution schedule, okay? If the beneficiary is disabled as a chronic illness, you're not subject to the 10-year distribution rule. If the beneficiary is less or not more than 10 years younger than the deceased, you are not subject to the 10-year rule. And if the beneficiary is a child who has not reached the age of majority, so in this example, say you have a child who is 5 years old and has not reached the age of majority, which is 18, that 10-year rule does not apply. Now, once they reach the age of majority, that 10-year clock starts. But those are the exceptions to the rule for that 10-year distribution schedule. The CARES Act, and once again, that is an acronym that was passed in March of this year, March 27th of 2020 to be more specific. The CARES Act, that stands for Coronavirus Aid, Relief, and Economic Security Act. That's where the Paycheck Protection Program was developed. And you also got rebates. Many of you might have received a rebate from the federal government. That was because of the CARES Act. You received $2,400 if you were a couple, $1,200 if you were single, and you got an additional $500 per child. In addition to that, CARES Act also gave us the $600 a week increase in unemployment benefits, which ran out at the end of June. They're now looking at extending that, and I suspect that the new administration will. That's one of their first things that they'll do is to extend that unemployment benefit a little bit longer, maybe to the end of the year, or maybe another 6 months. Who knows? The other provision in the CARES Act is that there is no required minimum distribution for this year. So each and every year, obviously, we just talked about the required minimum distributions. If you're over 70 and a half, 72 now, but if you were over 70 and a half and taking those RMDs, you don't have to take one for 2020, which means you're going to have more money in your piggy bank, right? If you're not taking out here, then that means I'm going to have more money in here. Now, you can also take out another couple provisions in the CARES Act just really quickly is that you can, if you've had coronavirus, been adversely affected by coronavirus, you can take out of your IRA if you're under age 59 and a half, and you will not pay a penalty. You will still pay tax, but you will not pay a penalty. A couple other interesting little caveats here is that the CARES Act also allows you to deduct $300 of a cash contribution that you would make to a charitable contribution, regardless of your need to itemize or if you're taking the standard deduction. It's what's referred to as above the line deduction. You get to take it no matter what. So that $300, if you make contribution to a charity, you get to deduct that off your taxes. The other one here, and this is just a kind of a little fun fact about the CARES Act. Remember when the pandemic hit pretty hard and everybody was scrambling for hand sanitizer? You couldn't find it anywhere. Well, hidden deep inside the CARES Act is for those companies that make alcohol for alcoholic beverages. If you used your alcohol and turned it into hand sanitizer, you got your excise tax was waived on your distilled spirit. So that's the reason why you see Anheuser-Busch and a lot of, I have a local distillery by my house, and you walk into that local distillery and there's all kinds of hand sanitizers there. That's the reason why that the distilleries, you'll see hand sanitizers made by distilleries because they're getting a break on their excise tax for it. So interesting little fact. So strategy number one, I'd like to see you dump a whole bunch of money into your qualified accounts, your IRAs, your 401ks. Now, I'm not sure. Depends upon your individual 401k, whether or not they will allow that, but I would check with human resources. Understand your 401k document, what's allowed, what's not allowed. Because as we go into the end of the year, your limits on your IRA are very simple. You can put up to $6,000 per individual, or if you're over 50, you can put in another $1,000, which they refer to as a catch-up provision. So your total contribution to your IRA is $7,000. So if you don't have a 401k, look to put money into that IRA. You have to do it by December 31st. So load up on that IRA. On your 401k, your limits are much higher. $19,500 per individual on the 401k. Plus, if you're over age 50, you got $6,500. So that is important as well. So as we go into these last 2 months, you might want to look at dumping extra money into your IRA or to your 401k so that you hit that ceiling and get that maximum tax break. Now, why do we want to invest in our IRA or our 401k? Because in most cases, especially your 401k, your investment choices are limited. Well, here's the reason why. Okay, very simply, there is an advantage of contributing to your qualified account. And here on the here on the left, you'll see if I put $1,000 into my 401k, it means that I have $1,000 that goes in because I don't know why my pen is doing that. But anyway, $1,000 goes to work for me. Put in $1,000 goes to work for me. And again, I mentioned the midterm bucket for our clients who are listening in on this webinar. It's going to take $1,300, $1,316 to be more specific, if you're in the 24% tax bracket, just to get the same $1,000 into your account. So it's going to take a lot more money to put it into your midterm bucket than it would be your IRA. So right out of the gate, you've got that advantage of not paying taxes on that money that you contribute. The other thing here that is not that is overlooked a lot of times, but you may enjoy the match from your employer. And a lot of times an employer will, for instance, match 100% of the first 3%. So if you put in 6 and they match 3, you're getting 50 cents on the dollar. And that's a 50% guaranteed rate of return that you can't get from any investment from anywhere. So make sure you're contributing at least up to what they're willing to match in that 401k for the benefit of the tax deferral and the benefit of not paying tax on what you put in. So let's expand on that a little bit. Let's talk about tax deferred account versus a taxable account and the advantage of the tax deferred growth. So here I'm taking an example of $100,000 initial investment. We're going to do a 6% rate of return. We're going to do it over the last, let's say we'll do it over the next 20 years. At a 22% tax rate, you can clearly see here that on average, an equity type of account, you're going to have $320,000 in the tax deferred account. You'll have $241,000 in the taxable account. Once again, for our clients listening, it's the midterm bucket account where you will acquire $241,000 in your after-tax accounts. In your tax deferred accounts, you're going to accumulate somewhere about $320,000. Well, what about when I go and take that money out, Lon? I got to pay tax on it eventually. You're absolutely right. You will. That is not an inaccurate statement. And here you can see that even after we pay the taxes that are due from our accumulation, we end up with about $40,000 more than had we not done it. So even after that, the tax deferral, it pays, even after we pay the taxes at the end, it pays to defer those taxes as long as you possibly can. Strategy number 2, well, I would like to see you convert, or not see you, but consider a traditional IRA to a Roth IRA conversion. And we talked about this in one of our very first webinars a couple months ago, which you can download off of our website, www.pineswealth.com. We'll have that available for a replay for you. But converting a Roth in this environment is maybe something that you should consider before the end of the year, simply because of where we're at with tax rates. Because when you convert from a traditional IRA to a Roth IRA, it's a trade-off for you, right? Because you're paying taxes on the amount that you convert, right? So I'm paying tax up here, but what does that provide for me? That provides me with 2 things. Number one, if the tax rates are going up, that means I get to pay a lower tax rate on money that I'm converting now because rates are going to go up. And the second benefit here, and this is big, is because of the required minimum distributions. Because when I take that money out of the IRA and I move it or convert it to the Roth, I reduce my required minimum distributions. My future required minimum distributions, because there's less in there. So not only am I paying at a lower tax rate, I'm also reducing, when the tax rates go up, I'm reducing the amount that I have to take out. So this is a strategy that we're seeing a lot more, strictly because of those 2 reasons. The other consideration here, and I can't stress enough, is that you have the available resources to pay the tax that's going to be due on this conversion. You have it from another outside source to pay the tax. You do not want to pay the tax out of your conversion, because then it's kind of like an endless loop of a tax nightmare. Because if you're wanting to withhold the tax out of your conversion, you got to convert more, which means you got to pay more. So it's kind of an endless nightmare of taxes if you do not have a separate account to pay those taxes that are due on the conversion. So make sure that's a consideration. Really quickly, let's take a look at where the sweet spot is for conversions. And what you're looking at here is you're looking at two different brackets. You're looking at the tax brackets before the Tax Cut and Jobs Act of 2017. So this is the before, and this is the after. You'll see obviously the difference between the tax rates. Now, what we commonly see here is the $250,000 and below. That is a sweet spot for a potential Roth conversion. Reason being is because if you have a greater income than $250,000, guess what you got to pay? You got to pay a 3.8% Medicare surtax. That was part of Obamacare. So we have to be careful of that. Now, you do not pay that surtax on the amount that you convert, but it could potentially push your income up to where now you're paying that surtax on your investment income where you weren't before. So that's what you have to watch out for here. And that's the reason why we're recommending $250,000 and below is really a sweet spot. The other difference is this, because if, as you can see here, $250,000 is the 24% tax bracket. Under the old tax bracket, and again, I'm not smart enough to know and to be able to predict what the tax brackets are going to look like. Nobody is. All I know is what the tax brackets were. And I deeply suspect that future tax rates are going to be based upon what they used to be. So in this case, the difference between this $250,000, I'm now in the 24% tax bracket. I was in the 33% tax bracket. That's a 37% difference. So you can save, if you keep under that $250,000, about 37% under the current Tax Cut and Job Act brackets, which is a big, big savings to you. So consider that, again, under that $250,000, because you're going to save yourself that 3.8% in the surtax. And once again, want to make sure that we are able to pay the tax that's due on this conversion out of existing funds somewhere else, not out of the transaction itself. That's going to make a big difference. So other considerations, the reasons why for conversion, simply put, is a Roth IRA. Roth IRA, there's no required minimum distribution requirements, and it passes along to our beneficiaries income tax-free, as the rules are written today, of course. And then for you higher income type of or higher income earners, the backdoor Roth IRA could be a strategy that could be utilized for you. And how you do that is you simply make a contribution to a tax deductible, excuse me, that's not correct. You make a contribution to a non-deductible IRA, and then you convert that. So there's no rules, there's no income limits when you make contributions to non-deductible IRAs. You can make $1 million and make a contribution to a non-deductible IRA. But again, if you want more information on that, let us help you. I was just doing this for a client in California last week. We went through a Roth conversion scenarios for her and determined that we indeed were going to make a Roth conversion for this year before December 30th. So let us help you with that. Tax bracket management, strategy number 3. This is kind of a simple one, but in order to do tax bracket management, you got to know what your taxes are, what you're paying. And here I've given you kind of a rundown, again, not to make you an expert here, but giving you a rundown of what the tax bracket rates are. I mentioned earlier, here's their seven brackets. Long-term capital gains are at 0, 15, or 20. By the way, the Biden administration is considering increasing the amount of capital gains tax that you will pay. Your net investment income surtax, the 3.8%, we just talked about that. Standard deduction is $24,800. That was, again, changed with the Tax Cut and Jobs Act of 2017. It increased that standard deduction, so it really minimized your need to itemize. And a lot of people have been benefiting from the bigger standard deduction rather than having to itemize. SALT deduction, that's state and local taxes. You're capped at $10,000. If you pay anything more than that, you can't deduct it, whereas before you could. Mortgage interest, you're limited to $750,000. If you have a mortgage bigger than $750,000, you're not going to deduct that interest, that which you pay on the amount over and above $750,000. Charitable deduction, you can only deduct 60% of your adjusted gross income in 1 year. And if you do not exceed the standard deduction of $24,800, well, you can't itemize. So be aware of that high standard deduction as whether or not you itemize. But here's the interesting part. The CARES Act, which we talked about earlier, eliminated this provision for this year only. You can deduct any amount that you want. It's above the line deduction. Okay, but keep in mind, if you're not going to itemize, if your contribution is not bigger than what your standard deduction is, then obviously it's not going to benefit you. But if you're making a large contribution to your favorite charity and you're able to itemize, this could be huge because this restriction now is gone for 2020. The CARES Act saw to that. And we talked about the deferrals on the accounts, on your 401k and your IRA as well. The other thing here is consideration of tax bracket management is to possibly accelerate or push back income and to accelerate or push back deductions. So if you're going to, maybe you're going to be in a higher bracket next year. And I have a client that usually she, at the end of the year, tries to load up on her deductions for her business. And she was considering buying new computers for her business. And we talked through it and decided that because she was going to have, coming out of coronavirus and possibly having a significant increase in her income next year, we talked about pushing those purchases out 30 plus days. So maybe the first week in January, she makes that purchase because her income is going to be so much higher. So you might want to talk about pushing back those deductions and vice versa. Accelerate those deductions. Simply because I'm not going to make as much money next year as I am this year, maybe you want to accelerate those deductions. And same with your income. Because tax brackets are only going up, especially if we get a change up at the top, you may want to consider accelerating your income this year so that maybe you accelerate enough income to where you stay in the bracket that you're in, but you push up against that upper limit of your bracket. So that may be an idea to, again, manage that tax bracket more effectively. Last but certainly not least, tax loss harvesting. You know, I always think of harvest time. Everybody always thinks of harvest and pumpkin spice and leaves and all those things. When I think about harvesting, I think about tax loss harvesting. What is tax loss harvesting? Very simple. It's capturing your losses within your taxable accounts and putting them into your pocket to offset future gains. And I know that sounded like a mouthful, but again, let me repeat. It's capturing your losses within your taxable accounts and putting them in your pocket to offset future gains. So what does that look like? Well, lucky for you, I have an illustration. Come on, you can't talk about tax loss harvesting without an illustration, right? Okay, so let's talk about tax loss harvesting and look at an actual example. So here I have an investor who has two funds. We'll call them Fund A and Fund B. Well, on Fund A, we have a $30,000 gain in Fund A. And this particular investor doesn't know anything about tax loss harvesting. His advisor has not mentioned tax loss harvesting to him. And as a result, he doesn't know anything about it. So he goes and he sells that as part of a reallocation. Or maybe he needs the income, who knows? But for whatever reason, he takes out that $30,000 at the long-term capital gains rate of 15%. He's going to owe $4,500 on that transaction. Tax loss harvesting has taken that Fund B, which we may have lost $15,000, and we're going to offset that against our capital gains. And so now we only have a $15,000 net gain. And at that same long-term capital gains rate, now we'll only owe $2,250. So it's a way to significantly reduce our income, reduce our taxes of what's owed by that tax loss harvesting, by selling our losers, if you will, to offset any gains that we may have experienced. And oh, by the way, I can take this proceeds of the sale of Fund B, and I can move them into a similar investment. We'll call it Fund C, and still capture these gains to capture these losses to offset my gains. So tax loss harvesting, again, simply taking your losses and offsetting them against your gains to reduce your tax bill. However, you have to be mindful of the wash rule. And I'm not talking about washing your hands. Okay, I know it's important to do that in a pandemic. You know, my hands have never been this dry ever in my life, especially in the middle of July. You know, my hands are cracking because I'm washing them so much. But anyway, the wash rule is very important in tax loss harvesting. The reason why is because you have to, when you sell for that loss, you can't turn around and buy back that which you sold within a couple of days. You got to wait at least 30 days to buy it back. That's considered the wash rule. Because if you do buy it back, if you sell, like in the previous example, if you sell that Fund B and then you turn right around and buy it back 2 days later, and the only reason why you sold it is for the loss, IRS says, no. You got to stay out of that particular position, a particular fund for at least 30 days, which could be a problem because if you're in a rising market, now all of a sudden you're missing out on the upside capture. In addition to the sell side, you can't buy a fund for the sole purpose of losing money in it to deduct it. You have to hold it at least 30 days. So you can't buy it and then turn right around and sell it. You've lost, let's say the market went down on you dramatically. You can't sell it 2 days later for a loss and then turn right around and claim that. You have to own it at least 30 days. So you got to own it 30 days before and 30 days after your trade on the tax loss. So the other rule here is matching up your capital gains and losses. So the rule is that you can offset capital gains to the extent of capital losses plus $3,000. So again, let's go through a quick example and see how that works. So let's assume that I have a Fund A that I'm up $20,000 on. I have Fund B that I've lost $60,000 on. And again, I'm just going through the numbers here. I don't know why my pen's doing that, but that's a 60. So I've lost $60,000 and I've made $20,000. Again, the rule is you can offset capital losses to the extent of capital gains plus $3,000. So what I would do here is I would take $20,000 from these losses. I would bring it up here to offset these gains, which makes my gain zero up here. So if I take $20,000 off of here, because I moved it up there to offset my gains, that leaves me with $40,000 worth of losses. Remember, the rule is capital losses to the extent of capital gains plus $3,000. So I can add here, I can subtract another $3,000 up here to deduct that $3,000. Well, because I moved $3,000 from here up here, I have to take that off of my balance. So now I have a balance of $37,000 worth of losses that I get to carry forward. I never, ever lose them. I put them in my pocket and I use them for future years, but I may have capital gains to offset for future years. And if I don't have capital gains next year, I can take that $3,000 loss, which reduces my amount in my pocket from 37 down to 34, and I get to keep that. Again, you never lose it. So that's what we mean by matching up your losses and your gains. So that will certainly help cut your tax bill, part of tax loss harvesting. So coming into the final recap here, we talked about the impact of taxation. We talked about the Secure Act and the CARES Act and the implications for the individual investor. We talked about loading up on that IRA and your 401k, and make sure you reach out to your human resources contact at your company to see if you can, if that is an option, if you can load up on your 401k for these last 30 plus days. Roth conversions now are becoming more and more realistic and favorable for you because of the tax rates that are going to go up, especially if we get a change at the top. We know tax rates are going to go up. So that those conversions could be absolutely critical this year. But you want to make sure you put pen to paper and makes sure that it makes sense for your particular situation. Managing your tax brackets, again, accelerating that income. We talked about the gloves off for the AIG limit on your charitable deductions. And we also talked about tax loss harvesting. But I want to kind of end on a good note to say that if you do not have a tax person, please find one. Collaborate with a tax professional. We are not tax professionals, our firm. We do financial planning for our clients, and we do implement tax strategies, but we're also going to work with your accountants, collaborate with them as well to make sure that we're all on the same page. And if you're not working with a financial advisor, I encourage you to sit down with an accountant and collaborate with him on some of these strategies that we talked about and see what's available for you before the end of the year. Remember to follow us on social media, Facebook, Twitter, and LinkedIn. Also, we have a podcast, Emotional Wealth, that you can listen to. That is available on our website. But the last thought that I'll leave you is I want you to act now. Don't let your questions go unanswered. If you have questions about taxes, because we've discussed the implication of paying too much tax, it may mean the difference between you being successful and unsuccessful in your retirement. Let us help you. That's what we're here for. Schedule a year-end tax planning review with us today. We'll go through your situation. We'll talk through it, and we'll determine whether or not there's some tax strategies that we can utilize to take advantage of this year-end, this push to year-end. So let us help you do that. I thank you for your time. Again, one of the most precious gifts you could ever give anybody is the gift of time. And I appreciate your time today. So if you have any questions, please feel free to reach out to us. Be more than happy to, we'll get back to you as soon as we possibly can. And we'll make sure that every question gets answered if you ask a question here today in our webinar. Our next webinar is going to be on estate planning. Be looking for that. Have a great week. Have a wonderful, safe Thanksgiving holiday.